What do you see as the biggest risk?
I have a micro and macro, and I'll speak quickly because I know we're limited on time. So there's two things that have just, in my world, I'm becoming very sensitive to. One's actually insurance related. The micro issue is an insurance related issue, and it's the spike in insurance premiums due to crime. I don't know what's happening. You would be able to speak to it more than I can, being that that's your industry, but for whatever reason, I feel like insurance companies are taking more notice of that particular item, and the crime in the area. And just to focus on and give some context, most of my deals are in Atlanta, and the Atlanta crime rates, I think, have been a significant issue and a risk factor for as long as I've been in that market, and surely before. But for some reason now, I see it across the board on all of my deals. The insurance premiums are spiking, and the brokers are constantly talking to us about crime being the reason for it. So that's not the biggest, that's my micro risk that we're very sensitive to, and we just have to be aware of it. And we're paying now more attention to crime not only on the property but in the surrounding areas. We now research other buildings, that if we're bidding on a property, we research the feedback on all the other buildings too, because we could rehab a particular property, but what's going on the neighbor's property, it's going to affect you. So we are much more sensitive to that particular issue. On a macro level, and I'm sure a lot of your guests are talking about, preparing for the next recession, whether it looks like a recession, a crash, or is it just an adjustment in the market? And that's coming. I feel that that's coming within the next 2 years. We do three specific things now, in preparation for what inevitably is coming. One, we are battle testing our underwriting in a much more significant way. We've started to do a lot of research. We're not there yet in getting all the answers, but we're really starting to dig deeply in the market that we're in and look at where were the rents during that last crash. We're battle testing our underwriting to the extent that we're now looking at our underwriting and saying, okay, let's say it crashes in the next 2 years, and bringing down the rents significantly, maybe not to what the last crash was, because I don't think whatever's coming is going to be that significant, but literally bringing down the rents to the point where, as long as we can still can we still make our debt? Like, we're at the point where second thing, we're locking into long-term loans. So if we have to go through a period of time where maybe the investors aren't getting returns, or substantially decreased returns, we're willing to accept that as the reality. But because we're in a long-term hold, and we'll come out of that, and we'll come out on top. But we've never done our underwriting prior to now where we were stressing the deals that much, like looking to see, do we still, if we put it this way, prior to this type of underwriting, if the deal looked that bad with lowering the rents, we took a pass. I don't want to just make our debt payments. I want to be able to return 9 to 10% during the hold period and double digits after sale. But now we're willing to accept less, and we're educating our investors on it as well. I mean, it's really important to just educate them and set the expectations that there could be deals that you have to hold on longer than you anticipate to ride out the adjustments that are inevitably occurring. So we're battle testing our underwriting. We are not going into tertiary markets right now. 2-3 years ago, we were much more willing to bid on properties, and in fact, we did bid in tertiary markets. Now, it's about staying in those primary markets. I mean, right now, we've doubled down in Atlanta. We feel very comfortable there. Sure, the price points are high, cap rates are compressed, competition stiff, but we also love the Atlanta market for the wealth of industry there. And what I mean by wealth is the diversity of industry in that market, the continued population growth, the continued expansion of the industries that have been there. It is that hedge that we feel we need to help sustain us when we will be riding out the storm that's inevitably coming. And the third thing that we're doing, while most of our deals we're looking to place long-term debt, try to lock in for the best rate, we would not necessarily resist a deal that needed a bridge, but it needs to be a bridge where, minimum 3 years with the option to extend at least another, 2 to 3 years. Because you do not want to be in a situation in year 2 to 3 from now when the crash happens and then we have to do the refi. So a bridge is fine as long as you do have the ability to extend out so that you can, make sure that your deal obviously can sustain the interest rate that you're paying on the bridge. But assuming this is happening, I'm going to say 2 years out from now, you want to be able to hold on to that bridge and refi after that crash. So we haven't seen a bridge deal yet that we need one, but we would not be adverse to a bridge as long as we can get those terms.